Hey everybody, it's PJ Patterson. Hope you are doing well. This is a market update. It's been a little bit over a week, probably almost 2 weeks since my last update, and I can't really say that a lot has happened in that time frame. It's just been a very slow grind on a number of things, but there are a number of things I want to touch on today for you, including oil, the inflation outlook, what's going on with bank lending, gold, and interest rates, and that relationship, and just a little bit about the metrics in the New York or on the New York Stock Exchange and what's happening there. I'm starting off today just with an interesting article from CNBC from today or overnight that, as I'm sure you all know, the U.S. and China continue to negotiate on this trade deal, and it's gotten a lot of media headlines, a lot of financial press. But the reality is it's really a sideshow. There's not a lot about this that makes a huge difference in terms of the effect it will have on GDP, either in China or in the US. And it's really kind of, I think, just a media attention grabber for people that are watching the Trump administration and are watching what goes on in China as it relates to their relationship with the U.S. So really not much to say about this, except that, and this was an interesting thing I heard today, listening to an interview with Kyle Bass, who's a hedge fund manager that is very concerned about China and their banking sector. One of the issues with this trade negotiation, and one of the issues with China in general, is they have a huge banking sector that is massively overlevered. Now, I am simplifying that to say the least, but China does have some problems, and they have a very highly levered banking system. And this could become a problem down the track, depending upon what goes on with the Chinese economy and whether they're able to effectively get their growth rate kicked up again and sort of become that engine of the world again, which they have, I think, in large part lost that status. They had a big stimulus back in the 2007-8 financial crisis, massive amount of stimulus. They pumped up their stock market, and that pumped up, they put a lot of money into their system, and that got China going again as one of the world's growth engines. That sort of petered out. They did it again in sort of the 15 range, pumped in a bunch of more stimulus into their economy and market, and that petered out. And now they're facing another period where it looks like anyway, they're pumping a lot of money into their system, into their financial system. And that has driven Chinese stocks over the last couple of weeks to be very, very strong performers. Very much a calculated and manipulated effort. And I guess really all I want to do to wrap up the China thing is to say it bears watching. The trade negotiations bear watching, but the ultimate difference it makes in China and really in the U.S. is minimal. I suppose the larger argument and the larger thing to say about trade is that we need fair trade amongst all countries in the world. And I think that's been the beef that the U.S. has had with China for so many years, is that it's been an unfair playing field. It's not a level playing field. The Chinese have subsidized a lot of industries. They have pumped a lot of product and so forth onto the market to steal market share. And the Chinese do have a big problem with theft of IP and technology from U.S. firms and other firms around the world. So there are some issues there that need to be dealt with. In any case, just thought I'd bring that up because it's kind of interesting. Moving right along, I want to hit oil. Because oil has been a huge, probably a sleeper. You don't hear much about oil. You've probably noticed that the price at the pump here in Australia has gone up. I think I can remember filling up the car as much as 2 months ago for maybe $1.08, $1.09 a liter. And now we're pushing the $1.30 range per liter, depending upon the day of the week that you buy your fuel. And if you just look at this chart here that I'm showing on the screen now of light crude, this is the contract, the futures contract that trades in Chicago. on the Chicago Mercantile Exchange, it's up 42% this year, or the price of oil, that is. You can see that we had that V bottom in oil back in sort of late December. When the markets were crashing through December, we saw oil just fall off a cliff. And then all of a sudden, we've seen the reflation of oil and the oil price. Now, this is going to flow through to a number of areas, and it's beginning to do that. The main area that you're probably going to see this flow into is the cost of food. It's going to, or should rise, but the cost of transport and other things are going to now factor into a number of metrics. So it'll be a slow process, but it'll probably just all show up one day in the CPI numbers. And I'm just going to see, I do have some CPI numbers here. I'm just sorry, I'm going to flick through a couple of things and see if I can find it. Here we go. This is the inflation rate in Australia. And interestingly, sort of since 2014, it has been going down. Thankfully, inflation has been decelerating, or we've been deflating, which is a good thing for you and I, because if inflation is dropping, that means our purchasing power, what we can buy with the dollars that we earn, the Australian dollars that we earn, increases. So we want to actually see inflation dropping, and we want to see it staying low. But interestingly, since probably late 2016, early 17, we've started to see inflation begin to creep up. And what I'm really curious to see is what will happen with this number as we see the effect of oil prices moving through. So obviously we'll have to wait a few quarters probably to see that data, but I suspect that we're going to see that creeping up. I think I might have one other inflation number here. Maybe not. That was the trims. Well, this one is quite interesting too. So where we'd probably start to see the oil price filtering through first is Australian producer prices. And because transport costs and oil as a fuel cost, as an input cost to producing goods and services in Australia, is what drives that higher. So what you can see here is since early, probably 2019, well, late 2000, mid to late 2018, early 2019, we've started to see that producer price index begin to creep up. And this has been something that we'll probably continue to see rising. It'll just be interesting to watch, really, to see what happens to it. But I suspect that will continue to rise. And that's going to have a flow-on effect, again, to the inflation numbers. And then, of course, to the amount of money that people have to spend. And that's going to affect a number of other things. So just looking at the GDP growth rate now in Australia, this is quite an interesting chart. It's got quite a bit of data there, and it's up and down and all over the place, I suppose. But what I'm most interested in is just watching what's happened to our GDP since sort of early 2018. It's just fallen off a cliff. I mean, this sort of GDP growth, 0.2%, is anemic. And it's a big problem for Australia. We are right now mired in very low economic activity, and our GDP is decelerating. So I suspect that this is a concern for the RBA. It's a concern for the politicians. It's a concern for the overall economy, and for what's going on in Australia. So again, with GDP dropping, inflation potentially rising, producer prices rising, I've got a unemployment rate. Actually, this is average weekly wages. They're actually going up. This is another sign of inflation. This fact that the average weekly wages are going up. And as you can see, since 2014, I'm sure I could go as far back as 10 years, and it would just be the slow sort of march higher. They typically don't drop. But all of these things are going to be adding to pressure on our market, on our profitability of our companies, and so forth. So we're sort of looking at a period now where if GDP is dropping, that means we're producing less as a nation. If wages are rising, someone is bearing the cost of that initially. Producer prices rising, someone's bearing the cost of that initially, and that's corporates. And what that's going to do, I believe, and the data will either prove or disprove this, but it's going to slow down corporate earnings in Australia. And I think that is going to be one of the effects of the rising wages, slowing GDP, and rising input costs like oil. So I think the crux of all of this for you as a client of mine is that it means that we're not out of the woods. We're not by any stretch of the imagination going to return to the heady days of 5 and 6 years ago when Australia was just firing and we had a fantastic economy. We were booming, all that sort of stuff. We are very much in a stagflationary environment, and economic growth has stagnated. So that how we deal with that, I guess, ultimately what I'm saying is how we approach that from an investment point of view is very, very important. I want to just move on now to a bank lending discussion. I spotted this article today that home loan arrears, are rising nationwide. Now, I don't read a whole lot into these metrics because the arrears rates are still quite low. But the fact that they're rising is probably the most concerning for me, that we're seeing arrears rising. And in particular, we're seeing investor mortgage arrears rising. We're also seeing that in owner-occupied. So this little sentence here, the rise is driven by a 13 basis point increase in investor mortgage arrears. And however, the owner-occupied loan delinquencies did increase, but probably to a smaller margin. So 13 basis point increase in investor mortgage arrears versus only a 9 basis point increase in owner-occupied. I think what that tells you is there's still a lot of stress out there. People are, interestingly, Aussies are very good about paying off their home loans, but interestingly, we're seeing that metric rise. So probably not something to be overly concerned about, but certainly bears watching. What I can tell you as well is that bank lending continues to be a very tough environment. We're continuing to see rates moving up, although some banks now are starting to price different types of loans, like some fixed interest lending. 2 and 3 year rates are coming down, but by the by, we're seeing rates rising and being adjusted higher. We also continue to see approvals being pretty average, marginal, probably is the best way to put it, and difficulties getting loans. I continue to work with a number of my clients on borrowing, and I can tell you firsthand experience, being a boots on the ground mortgage broker, that it is still very, very tough out there in terms of getting money for clients. Banks are crawling all over applications. They've taken the royal commission stuff probably way too far in terms of how they're looking at expenses, all of these things. So I believe what that translates into, or will translate into, is continued sluggishness in our housing market. No sign of recovery anytime soon. So if you are holding off selling or you're banking on a big recovery, I think you're going to be disappointed in the short term. Just want to move on to a quick conversation about gold and interest rates. So for those of you who know, I am very much a hard money person. I think gold is absolutely critical to have in your portfolio. But one of the relationships that I probably haven't explained before is, and this is what one of the things that drives the price of gold, is when interest rates are rising, the opportunity cost effectively in holding gold becomes higher. Because gold doesn't provide a yield, investors typically will, if the risk-free, government bond yield is rising, then investors will typically allocate capital to something that's providing yield, and specifically something like the risk-free yield of a government bond. And so when rates are dropping, however, the appetite for holding gold is much higher. So we have seen rates peak in the last probably month or two, and are beginning to, this is the government rate and bond rates, specifically in the US, but also in Australia, they are starting to decrease. So it's probably no wonder that we've seen gold get a bit of a bid here. It's hovering in that $1,300 range and is going to probably eventually really take off, but it's just at the moment in quite a tight trading range, I guess, waiting to see what happens with a number of things. But I just thought I'd quickly explain that relationship between gold and interest rates, because it is one that I am now watching, and probably using that more as a timing mechanism as to when I might allocate capital to more gold positions. One of the other quick things I wanted to mention is that the New York Stock Exchange, specifically the S&P 500, has been doing very well recently, and seems as though it may continue to sort of go up. But the interesting thing about its rise is it is rising on declining volume. So when I'm talking about volume, I'm talking about the number of shares, the amount of shares traded on a day-to-day basis. And volume has been declining, it's been dropping. And that is typically a bad sign for the stock market. If there's declining volume on a rising stock market value, that's usually a big warning sign that the rally will not continue. What you actually want to see is rising volume and rising market indices. That is a very bullish signal. When you see rising volume and declining markets, that's also very bearish, because it means people are dumping positions and they just want to get out. So right now, again, just to reiterate, we have falling volume but rising prices. And so unless volume starts to pick up, and it certainly has not been picking up, this is in the New York Stock Exchange I'm talking about, that's basically a warning sign that we may see the market roll over here soon. Will that represent a buying opportunity? Quite possibly it will. Quite possibly it will. So I'll be watching that. I did want to show you a couple of charts. Hopefully this chart will open up, or a chart. A chart, yes, a chart. Hopefully this is showing up now. I've put a couple of things on this chart just to give you an idea of performance, relative performance of asset classes. And what I have here is the All Ordinaries, which is XAO. That's the ticker symbol. That's the black line on this. And sort of for, I think this period is, let's just go up here to a year. I'm pretty sure this is a year. No, it wasn't a year. I'm not sure what that was. Anyway, we'll put a year up here. What you can see is that the XAO has done okay over the last year. It was up, then it was down, then it's back up. It's up around 5.9% or 5.8% over the last year. One of the things that's absolutely killed it, though, is technology. So NDQ is the Beta Shares NASDAQ ETF, and it is an ETF that represents the NASDAQ Technology Index. And as you can see, technology has just been ripping since that big sell-off that we had into last year. So, it has well outperformed. Technology has well outperformed industrials, probably from the point of view that technology companies, and the NASDAQ in particular, is an index that has companies that are future growth companies. And so, when you look at something like, let's say, an Australian bank, for example, very, very old school, old world holding. They're large companies that pay dividends, but they're not innovating, right? Their growth story is that, they're just not going to represent massive amounts of growth or innovation going forward. Versus the NASDAQ, which has companies like your Facebook and your Googles and your Netflix and all of that, and hundreds of other companies that represent the future of the world, and innovative products and innovative solutions and all of that stuff. And so what you'll probably see, not all the time, but probably most of the time, is you'll see something like the NASDAQ outperforming the industrials. And you can see that orange line here bouncing around. It's almost over just about most time frames. It's outperformed the industrials, and by a wide margin, but in some cases by huge margins. So what are we looking at here? Almost 20% outperformance. Then I've got on here the utilities index, which is, I guess, this sort of gray line. This is the utility index, and this is of utility companies in Australia. Even utilities have outperformed the industrials. And what is the XRE? That is the real estate index, and even real estate trusts and so forth have outperformed the industrials. So I think the point I'm trying to make here is that I am now looking at the relationship of various sub asset classes and looking to get more data driven in terms of where we allocate capital to get and capture this sort of outperformance of, holding the all lords versus holding technology. Clearly, that would have been a fantastic trade to have had on since January. So that is something I thought I'd point out because it is now a big focus area for me to capture what they call alpha in markets and for clients. And this is one of those things that I'm paying much more attention to now as to how do I capture this alpha for clients. That's really about it today in terms of a market update. Hopefully that gives you a bit of insight into what's been going on the last couple of weeks. But again, overarching themes, oil, watching the price of oil, and in particular how it's going to impact inflation, keeping an eye on bank lending, what's going on with credit. I think it's still fairly tight, and I think that Australia markets are still going to be very sluggish and stagnant because of that. This is the real estate markets. Explained a little bit about the gold and interest rate relationship, and then talked a little bit about the New York Stock Exchange and some of the volume metrics. So if you have any questions, please do let me know. Please also remember to check in with a friend or a family member if you suspect that anything is not right. Are you okay? Should be every day. A day. Are you okay? Day should be every day. And then finally, thank you so much to everyone who has given me ratings and advisor ratings. If you haven't jumped in there to do a rating for me, I would really super appreciate it if you were to do that. It helps me in my business, and other people who are looking at my business can see that, the wonderful comments and the stuff that my clients say about me. So thank you very much. I will talk with you again real soon. Have a great week.